Hello and welcome to a masterclass in getting the right mortgage presented by Lang Financial. Hi, I'm Steve Lang and this is part 5, rates, variable versus fixed. So in the beginning videos, we talked about things like employment verification, down payment, closing costs. We talked about gross debt service ratios, TDS ratios, loan to value ratios, all the things that you need for pre-approval. Credit scores, 5 C's of credit. In our last video, we talked about our mortgage default insurance. Today's video, we're going to talk about fixed versus variable rates. Why would you choose one over the other? Hi again, my name is Steve Lang. I'm a dual licensed mortgage and insurance specialist here in Winnipeg. I work with Castle Mortgage Group and Castle Insurance to provide the best service we can. So these are our 10 steps to buying a house. So this is the Disney experience in Winnipeg. They're as close to it as I can get you. The first couple of videos, we talked about mortgage pre-approval. So things like down payment, deposit, closing costs. After you've done that, you go out, you talk to your realtor, you look at houses, you write offers, you wait. Though eventually you're going to actually get an offer accepted. So once that offer gets accepted, we have to talk about things like home inspection, appraisal, and then that CMHC approval. So once that happens, we actually move on to the approval process. So this is the approval based off the pre-approval that we had discussed earlier. So then we have to also talk about things like rates. So we talk about fixed rates, we talk about variable rates, what's the best for you. So what is a fixed and a variable rate? What is a mortgage rate? An interest rate is the amount of interest charged on a loan expressed as a percentage. So it is based either on the rate the Bank of Canada charges lenders to lend money or the bond yield. So this is an example of the Canada 5-year bond yield. So you can see at the end of January, it was 1.674%. Now, with it being at about 1.674%, you can see that it's come up quite a bit from the middle of 2020. So today's rate, we're looking at about 2.79%. Middle of January 2020, we actually have a rate or a 5-year bond yield below 0.5%. So when we were discussing things like rates back then, this is about less than a year ago, you can see that it was almost a full point lower. So back then it was 1.79% for a high ratio fixed rate. So the interest is usually paid as part of your regular mortgage payment, along with the amount paid on your principal. So what is a fixed rate? A fixed rate, when you agree to a fixed rate mortgage, your interest rate will not change during the term of your mortgage. So rates are usually offered by how many years you are wanting for the term of the mortgage. Now, a term in a mortgage, term is the actual length of time for which the money is being loaned. The term is shorter than the amortization period, and there's no surprises as you'll always know exactly how much your payments will be and how much of your mortgage will be paid off by the end of your term. At the end of the term, if there is still a balance and time left on your amortization period, the lender will normally offer a renewal with a choice of a new term and the interest rate available at that time. So this is our standard spreadsheet that shows us a rates. So First National is one of our great lenders, and this is an example of their spreadsheet. So you can see here we've got 1, 2, 3, 4 years for a term. So the reason you might pick a 2-year term or a 3-year term is that you don't plan on being in the house very long. You don't want to pay the break fees. So you're just going to do a 2-year term. Now, the more traditional ones are, of course, the 5-year, and then at certain times, a 7-year and a 10-year. But the 5-year is generally what's offered out there right now. So a conventional mortgage, as we discussed in the last video, so it's 80% or less loan to value. A high ratio mortgage is 80.01% or more loan to value. So remember, this is also called an insured mortgage. It's insured by the mortgage default insurance companies such as CMHC. So back to our sheet here, you can see that there's an insured line and you can see that there's a conventional line. So the difference between the two, the insured line is CMHC insured. So you've got a 5-year rate of 2.89%. And then you've got a conventional at 2.94%. So you can see that there's a bit of a difference between a conventional and high ratio insured. Now, a variable. When you agree to a fluctuating interest rate for the length of the term, then you have a variable rate mortgage. So the interest rate fluctuates with the bank's prime lending rate and varies from month to month. Now, we go back to this sheet that we talked about from First National. You can see in the top right-hand corner, there's what's called a prime rate. So today's prime rate is at 2.45%. Now, when we talk about prime rate, we talk about prime minus or P minus. So in this example, we've got prime or P minus 1.10%. And so if you go back to our variable rate mortgage, our prime rate here, 2.45%, we have a 2.45% minus 1.10%. That gives us a 1.35%. So that's your variable rate that would be for the mortgage term. Now, as you can see, the historical prime mortgage rates are quite low for the majority of the time. Back in the 80s, we saw some 23s and 24% up for the prime rate. But traditionally, over the last couple of years, and hopefully going forward, we've seen them quite low. Now, when we talk about mortgage rates increasing, so you can see that, back in the day, if it jumps up by 50 basis points, which might happen at the next rate change by the government of Canada, they might end up at 2.95%. So that's a 50-point jump. Now, you can see that even at prime minus 1.0%, we're still at 1.85%, which is quite a bit lower than the fixed rate. So when we talk about variable rate mortgages, there's two of them. So there's a variable rate mortgage, but there's also an adjustable rate mortgage. So a VRM or an ARM or ARM, obviously. When you're talking about a VRM, so the interest rate changes, your payment amount remains the same. However, the amount that is applied to the principal will change. So if the prime rate decreases, more of the mortgage payment will go towards paying off the principal. If the prime rate increases, more of the mortgage payment will go towards the interest cost. So your amortization period, the number of years to repay the mortgage, may vary. So if you're paying off more, it might come down. If you're paying off less, it might be extended. And it might be longer if rates have risen or gotten shorter. With the adjustable rate mortgage, the payment will automatically adjust when there's a change in the prime interest rate. So the prime interest rate goes up, your mortgage payment will be more. Prime interest rate goes down, mortgage payments will be less. Okay, but you maintain the original amortization schedule of your mortgage. So if you start out with a 25-year AM on your mortgage, it is going to stay a 25-year AM. Now, there's, of course, pros and cons to everything, right? The fixed rate mortgage, your interest rate in your mortgage stays the same for the duration of your term. Variable rate mortgages, it can go up and down. The pros on a fixed rate is that you know where it's at. End of the month, you know exactly what you're paying for your mortgage. A year from now, 2 years from now, 3 years from now, you know exactly what you're paying for your mortgage. So it makes budgeting a lot easier. The pros of the variable rate mortgage, though, is that historically, variable rates have proven to be much less expensive over time. The cons of a fixed rate mortgage is that if there's a difference between the variable and the fixed, it might not be worth the premium that you're paying for a fixed rate mortgage to be steady. And of course, the cons of a variable mortgage, well, it can go up and down. So maybe 6 months from now, your rate's up a little bit more and you're paying slightly more for your mortgage. Now, this is an example of the fixed versus variable. So you can see that the blue line is the fixed rate and that the green line is the variable rate. So you can see the majority of the time, the variable rate has quite a bit of a spread difference between the fixed rate mortgage. So that's something to look at. So when we talk about prime rate, remember there's 2.45%. So this is what most of the world, most of Canada has to deal with, 2.45%. But I just want to point out that if you're going to a bank such as TD or Bank of Nova Scotia, they have their own prime rate. So when they talk about giving you a prime rate reduction of prime minus 1.05%, they're actually basing it off their TD mortgage prime rate of 2.6%, not 2.45%. So your rate's going to be a little bit higher. So it's just something to keep in mind when you see all these fancy specials out there from some of the big banks. They have their own way of getting around things. So again, if you have any questions, please don't hesitate to go to my website and sign up for an appointment. You can email me or you can just give me a call at 204-797-8543 and we can chat about your mortgage obligations. Take care.